was almost convinced that music could change the world before that, but now I'm absolutely convinced it can. It really can. Now we're going to talk about some of the problems and some of the challenges that startups face in the early days. Things like product design, market research, team building, fundraising, and many other questions. Our next panel is going to discuss this in full. So please give a warm welcome to Krystyna Forsenska, co-founder at TalkDesk and general partner at Indico Capital. We have Julie Krantz, partner at Lightspeed Ventures, Sergio Massana, partner at Antler, Ben Marrell, founder at Briga Capital, and our moderator for this session is Anna Heim, and she is a journalist at TechCrunch. So please give them a big round of applause, and they'll come out on stage.
We're here to discuss VC trends, but I want to make sure we keep a balance. So we're going to be talking about the state of things, how they are, because we have investors here who really have their finger on the pulse of what's happening. But we're also going to talk about the future, and especially what Europe has in terms of assets for what's coming next, and of course AI. So I want to start with you, Krystyna, because I know that you were at SuperVenture, which is another conference where VCs meet each other more than startups. And I was wondering what you heard in terms of the state, especially of late-stage investing in Europe.
Look, first of all, good morning, everyone. Really a pleasure to be here. I'm Krystyna Fonseca, and I'm a partner at Indico Capital Partners. We are a VC firm based in Lisbon, but investing primarily in Lisbon, in Portugal and Spain. So, in this economic environment, I think, rounds are taking a little bit longer to close, and I would say it's the time to invest in the basics and crack the value prop, the business model. I think one of the themes in Berlin was that investors, because of there was too much money in the market, lots of good companies, lots of money to deploy, we forgot about our own rules a little bit. So healthy terms as part of investment rounds, making sure you crack the basics in terms of the business model, you have really a solid foundation, because that's what's gonna make it or break it in the future. So I would say, as we are going through these turbulent times, it's time to focus on the basics and making sure you have a very solid business model. If that's the case, investors will come, investors will write you a check. I don't think that's a problem at all.
That's pretty optimistic, though. What I'm hearing from founders is that it's really difficult to bridge the gap between getting money for seed, which is still manageable, and getting that Series A check. So, Sergio, you're a fund investor across a lot of stages. What have you been seeing in terms of getting the companies from A to B to C?
Yeah, well, good morning, everyone. We're seeing a change, but it's not necessarily a bad change. I think over the last maybe 2 years, let's be more precise, we saw that valuations were growing dramatically, and they weren't really connected to the value that had been created on the companies. They were being driven a lot by the concept that you were almost pricing and priming for perfection and then adding a discount to it. So that created a massive gap between what was a normal seed round and a Series A, Series B, and Series C. We're seeing that bridge dropping. So seed rounds, they haven't really changed in price, and we're seeing a very strong connection between what you can now get for a seed round and the capital that allows you to get to Series A. You're seeing a little bit of a contraction on the multiples on the top. I would argue that's a good thing, because as an investor, we're in for the long ride. And if you think about a company that's going to be around for 6 years, you want to make sure that every single fundraising round actually matches the value of the company, actually matches a roadmap, a plan of what you're going to be building afterwards. So that adjustment is a needed one. Probably didn't need to be this abrupt, but you can't predict these things. But it's a very positive one, because in essence it creates better, more solid companies, and when Series Ds, E's, and G's come, they're going to be in a much better and stronger place.
Mm-hmm. Julie, I see you agreeing. Is that what you're seeing also from your perspective?
I think so, actually. I think it just goes back also to the point that you made, going back to, the fundamentals of what really makes a good business, right? And I think at Series A, at that point, showing true customer validation is simply important, and that's what people ask for. I think there's still sectors out there. There's an understanding that, for instance, more deep tech or, foundational ecosystem companies in the AI space might need a bit more capital to start off because you need to invest in the hardware, you need to invest into the research. But I think your traditional SaaS business is now expected to have, again, sort of around that 1 million ARR point at that point, and sort of solid customer signals.
Mm-hmm. Ben, let's see if you're a little bit more pessimistic, or I'm sure there are some bad news in the middle of it, the lack of IPOs for starters.
I'm going to make you cry. Hi, everyone. Before answering the question, maybe we step back for a second and look at, the food chain of investments in tech, right? And so we all know the sort of early stage, but there's a progression along the lines, and then ultimately there's liquidity events that, happen at normal prices. Obviously, in 2021, where the market was heading, IPO and listed markets were through the roof. I mean, a lot of people thought that, trees could reach the sky, that, everyone would stay on Netflix 20 hours a day. People got to normal reality and they realized, it's, so back to normal. And so a lot of investors who are part of that chain, don't want to pay a premium anymore. And I think, the disconnection we see today is very much that sort of premium issue. I mean, when you invest in a company at seed stage and there's, 3 people in a garage and not even a product, and you put, 1 million on 5 or 6 or 4 or whatever the valuation is, you pay a premium, right? You know that you pay a premium. You pay a premium because if the next day you needed to sell the business, it wouldn't be worth what you paid. So you paid a premium because you don't want to over-dilute the founders. You want to create room for growth. And you're like, okay, I'm happy to pay a premium because ultimately I think I'm going to get my money back, right? And that premium, sort of model was taken way further down. I mean, people were starting paying, immense premiums on Series A, Series Bs, and that's why, as of now, that market is a bit blocked because, I was talking to Series B investors in Berlin the other day, and these guys are now, I'm going to pay listed market multiples. And so if you do this, there's no premium anymore, so you're paying the price of the end of the value chain at the beginning of the value chain, and so you're like, well, if I want to pay multiples of the listed market, let's say 8 to 10, and let's make it 10 to make it simple. Well, to put 25 million in a company for 20% dilution at 100, this company needs to generate 10 million of revenue. Whereas a couple of quarters ago, people were like, I'm happy to pay a premium, and for 100, I'm happy to have 3, 4, 5 million of revenue and sort of look forward. So I think that contraction is really compressing the model right now, and that's where the whole market is a bit more, tense and blocked, I think. So it requires, more time to get there and more money as well. So I think, the Series A seed investors will have to play the game because if the Series B investors are waiting for a company to reach that 10 million mark, you don't get to 10 million with 5 million of funding. It's impossible, or very rare, let's say. So yes, you have to be a bit more scrappy. Yes, you have to be more cost conscious, but still, that will require a bit more funding, and that will be coming from the original investors, I think. So if you can, obviously, there's the ideal and then the reality, but if you can, as a founder, you need to build that sort of cap table where you know that people are going to be supportive going forward, because there might be a bit of a gap in your journey at that sort of stage.
Mm-hmm. Yeah, Julie, please.
I would just say on the premium point, I do think though that there's still businesses that are, if you're growing exceptionally fast, possibly even very efficiently, you still get a premium in the market, I think. So it's just like, I think it has just set to, again, people really look at your metrics very intensely, especially at Series B and even A possibly, but B and C. But if you outpace the market by a good margin, you get that premium still.
Yeah,
it's
sure.
not across the board, basically.
No, of course. I mean, it's not hard, but once again, now we're in this sort of paradigm where we're saying, to get to that premium, you
It's
still need
true.
to grow like back in the day,
Yeah.
but you need to burn less, and
Yeah.
there's inflation, right?
That's
so you're
true.
like, well, okay.
It's a
make
tricky
work.
one.
It's
Yeah.
a tough one, right?
It's true.
So,
It's true, yeah.
Yeah, that's tougher probably for a consumer company. Does that make you all more bullish on B2B?
I think there's also another dynamics we didn't cover, which is growth rates have slowed down because exactly like both on the B2B side and on the consumer side, people are buying less. Companies are saving cash, so they are like companies are not growing as fast as they were before, and that also reflects on how much investors are willing to pay, like, and then on your growth rates. So I mean, like, it's not that because on the consumer side, companies are growing slower, we turn to B2B, because on the B2B side, there's also some challenges. So I think this is a very good time for founders to go back to their cave, focus on the core of the business, catch up a little bit, and probably your best allies in this period are your existing investors that will like be there to help you like cut costs, burn a little bit less, and maybe secure a little bit more money for you to wait for the market to come back.
Which is why we're seeing so many bridge rounds and seed extensions and so on. Sergio, have you been doing a lot of these?
Yeah, we come early, so for us, we have the fortune of being able to pick founders which are already coming with that mentality. I think what we still see, and that covers what was said before, you're pricing premium for outliers. Incredible companies can raise whatever they want to raise. They obviously, but incredible companies led by incredible founders right now, they know the time. They understand that at this point in time, like Cristina was saying, you need to be smart, you need to focus on the basics, you need to understand that runway is a little bit longer. So a lot of the companies we're seeing now, they're not coming to you and saying, well, I'm raising a bridge because I was overpriced and this bridge is going to last for 3 months. They're saying, well, the fundamentals of my business with this bridge will take me to a place where I can actually raise a round, which is going to be meaningful, which is going to allow me to grow to the next level. So founders are coming down to this point in time, I think, in which they realize that the business is fundamentally different, the space is different. There have been a few changes that, if you think about the last 4 to 5 years, the cost of starting a company has collapsed. The speed of starting a company has collapsed. It's the time arbitrage you used to have between companies being born in Europe and going into emerging markets that was 1, 2, maybe 3 years has gone to weeks, and you're seeing even the flip side of that. So it's a lot more competitive out there. You have to be a lot better to be an outlier. And founders are understanding that at the model level, but also when they come into rounds, even if they're bridge rounds, there's a lot more thought than just, well, just give me money, I need to spend it somewhere.
Something I was reading also in a recent Atomico report is that the time frame from unicorn employee to new founders has really shortened, and I was wondering how that changed the dynamic. Ben, seeing so many second-time founders or people who have had executive roles at big unicorns and starting their new companies.
well, I think it's being an entrepreneur myself for 15 years. I think it's part of the construction of the ecosystem, and having that sort of exposure to what good looks like, what amazing looks like, what the learnings, you can get back to it with a different angle, and I think it creates a lot of quality, back to your point. So there's a lot of people with exposure to what amazing companies look like getting into launching their own venture as well. Obviously, what was true a few years ago isn't true today, and the world is changing. It's changing very rapidly. So yes, with the experience, a few tricks, but you need to be humble and sort of make sure that you learn your lessons and that you listen to people and that you make sure that you hire the best so you can build together. But it's true that there's more quality, and if you look at the type of entrepreneurs we see today versus a few years back, I think it has changed dramatically. The good thing, I would say, not for everyone to cry and go back home, with tears in their eyes, is that I think that sort of tension in the market now also sort of depollutes, I would say, the sort of craze around becoming a founder, raising money, being a rock star, going to shows. I think people now realize you need to create a business that's sustainable, that ultimately is changing the industry you're in, and as a consequence will be very well valued over just playing the valuation game and trying to raise at crazy numbers. So I think it's overall better for the ecosystem, and I think it's important because we are an ecosystem. A lot of people forget about this, but founders need VC money because no one else is stupid enough to back them. Putting checks of that amount in crazy valuation, no one does that. On the other end, VCs, they need founders who operate and ultimately get returns, because otherwise, they don't get funding from their LPs and the ecosystem dry up. So that's why I really think that we should work hand to hand and make sure that we are reasonable in what we do, which doesn't mean we shouldn't be ambitious, but we need to propel that ambition with some fundamentals so that ultimately everyone benefits from it.
The good news that Christina and I were discussing before the panel is that the VC side has changed quite a bit also, because here we have VCs who are a former operator, and definitely 10 years ago that would have been the exception. I wouldn't say it's the rule yet, but that's definitely a change that we were not seeing before.
Yeah, for sure. And to add to what Ben mentioned, I think the fact that more startup operators are either making it into VC or even to startups. There's an interesting dynamic. Look, I think the worst thing that can happen to an investor is that you have 10 people pitching you a very obvious idea, because everyone can have that idea. But if you've worked at a hyper-growth company, you have exposure to lots of interesting problems that are worth solving. So especially in Portugal, we have been a services economy pretty much, and I think people had limited exposure to problems that are hard ones, worth solving. And I think the fact that more and more people in Europe are working for startups and understanding and finding good opportunities to then start companies, it's a very interesting dynamic. And more we talk about the founder market fit. I think that's a huge advantage in today's landscape. So it's very positive that we have more and better companies in Europe. That's very valuable for the ecosystem.
So Julie, what are you excited about in Europe in terms of being prepared for the next probably AI or deep tech wave?
Yeah, I actually think that Europe is in a very exciting position, simply because the talent network that we have amazing universities in UK, France, here, Germany, very technical universities, amazing talent coming out of that. You have a whole deep tech hub in London, obviously, and so I think that nurtures that first wave of AI in Europe and could be actually really a competitive advantage for the region. Secondly, I think you can see already in obviously the media and the press, that there is a bit of a sovereignty push probably in Europe. And so I think there'll be a lot of potentially public funding actually flowing into that market as well, which will help sort of propel and stem quite capital-intensive businesses in that space.
Sergio, you expanded your fund across multiple geographies, so what are you seeing in Europe compared to maybe other markets?
Yeah, I think Europe is in a great place. It's the first time that we come into what's going to be the next decade of technological growth with an Europe that has multiple hubs. 2010, we had 1 or 2 hubs. In the 2000s, we didn't even have 1 hub. We were just tagging along Silicon Valley. Now you can very easily find absolutely world leaders in London, Berlin, Paris. We can even argue that in smaller ecosystems like the Spanish and the Portuguese one, you can find those. So we're structurally prepared. There are people that have been working in this for 10 years now. They went through the motions. They built something, or they were the first employees. So that kind of human capital has fundamentally changed. And more than that, we already have in pretty much all ecosystems laws, policies that are a lot more friendly. It's not impossible to have an ESOP. It's not impossible to set up rounds, funds, vehicles. So that creates a really, really strong, it creates the plumbing that allows for what's becoming afterwards. And in Europe is also, over the last 10 years, the focus on STEM, which has been really, really fundamentally changing, will allow us to move to the next level. It's not only about copying business models from the US, it's not only about even thinking about small localized products or processes that are in France or in Portugal or in Slovakia, but it's all about creating like world beaters. And in that sense, the next 10 years are going to be awesome. I think AI has massive, massive potential because we're in a shrinking economy and the number of people in Europe is plateauing and decreasing. So if you think about anything that has a deflationary impact, that can automate processes, that can standardize, you're looking into AI and looking what it's going to be built now. And we are in a really, really good position for that.
But Ben, we still don't have a Google in Europe, and sometimes we have our scale-ups leave for the US. Do you think that's still going to happen in the next few years, to see our best companies leave?
I don't know. I guess the question is, do we need a Google actually? Or do we need to create an ecosystem that thrives so openly that you don't need to have someone that's taking over a monopoly or quasi-monopoly type of positioning? I would argue that the beauty, and if you think about software went from a monolithical approach to an API-driven setup. You can very easily connect all systems. We still have in some sectors of tech a monolithical company leading and controlling the whole ecosystem. I would argue that real innovation will thrive if you have a lot of small Googles that can connect and build bigger companies in essence, but in essence that they can evolve separately and really drive innovation forward. So maybe we don't have a Google, maybe we don't need one.
That's interesting. Yeah, we're definitely seeing that also with open banking and disrupting big sectors, so that's really interesting. Do you see a lot of promise in that space, Julie?
You mean open banking?
No, in terms of API more broadly and disrupting big sectors.
I mean, I think so. I think it's been a while already for a few years, right? As you said, open banking has been around in Europe and I think has actually had a very nice regional play as well, with great outcomes actually. And so I think we'll definitely see more of that. And it's not gonna stop, yeah. And then again, also that's the whole point why basically, the Gen AI wave is picking up as much as it does, because it's so much more easy to integrate, to work with it. And so, yeah, that's exactly what's exciting right now, the availability of it.
Are you equally excited about generative AI?
I am very excited about generative AI. Like, again, huge potential. I think I'm just super curious to understand the market dynamics, because generative AI is not only calling the OpenAI APIs, which is what a lot of people think. And if that's it, then your differentiation doesn't exist, right? And there's still lots of companies generically say, no, we are generative AI now, and that's what it means. So we need to understand what are the dynamics that will mean differentiation in regards to generative AI, and those will be data, deep knowledge domain. So I'm super curious to understand how the market will shape in that regard.
Yeah. Ben, are you seeing enough innovation from Europe in that space? Do you think European companies can innovate?
On regulation. We are innovative on regulation, at least.
To me, and I'm going to be a bit controversial here, but I think there are overall bigger fishes to fry in Europe, to be fair. So if I look at, what's ahead of us, we have, from a societal perspective, an aging population. Right across the pond, we have a booming, generation in Africa. 1 billion people in the next 30 years. So if we don't do anything, this is going to be a fucking mess, right? So that's, to me, an even bigger thing that, the past wave of innovation we've experienced, which was more like, high touch, incremental, existing processes, but a bit better with tech, right? Now we have a big societal, issue, and on top of that, there's a climate one. And, AI is not going to change the way we, produce agriculture, we produce and construct, buildings, we produce energy, and this is the best polluting, industries in the world. So, if you add, agriculture, energy, construction all together, and transport, you're at sort of 90%, right? So that's the big piece we need to solve. And yes, AI can potentially, optimize for a couple of stuff, but can it solve the way we produce energy properly? I doubt it, right? So I really encourage founders to jump on the bandwagon, because it's big challenges equals amazing opportunities. So I think there's plenty of stuff to be done in these different spaces. And can AI be part of that? Probably, but it's not going to be the solution. Like recently I've seen tons of CO2 trading, accounting platform or marketplace. I'm like, guys, okay, fair enough, but you're not solving the damn issue there, right? You need to roll up your sleeve and do something a bit different. Well, we have to do that, right? So that's to me the more interesting part of it.
I'm glad you called it controversial, because I was on a panel on climate tech and AI here, and I would beg to disagree on some aspect, but I agree that AI is more of an enabler in that sense than a big disruptor. So are you bullish on climate tech, Julie?
Yeah, we're very, very bullish actually. We spent I think the last 2 years in Europe mapping the market. Have made a few investments, not all of them announced yet. I think how we think about it is there's almost like 3 buckets, right, that you can invest in. One is the SaaS and consumer businesses at the very first stage. We look at those like traditional SaaS investments essentially. But then you have more deep tech and then moonshot businesses. And I think what we're trying to wrap our head around is those are incredibly impactful and exciting opportunities. Just how do we marry that up with a typical funding trajectory of a business, right? I think you have to think about it more like a life sciences business almost, where you have a lot of upfront capital, monetization comes way later. Actually, an IPO probably will be a monetization event in a classic sense and a commercialization event. How do you think about return profiles there? So I think that's still a bit of a learning journey in the ecosystem. I also think for some of the real moonshot businesses, it would take different pots of capital. So think governments, think research, something like that, versus traditional private VC money, just because it's so capital intensive, and the patterns look very different. But I hope we get to do some of those exciting bets, and I'm generally really, really interested.
And Christina, do you think it's one of the strengths of Europe to also have this type of government money and university money?
For sure, and also maybe, I think we can claim we are a little bit more patient, and funding like moonshots is not something, maybe the 10-year funding horizon is not compatible, or we need to be a little bit creative in order to help these companies be in research mode for a while. We are so bullish that we recently launched a fund that focused specifically on the blue ocean economy. So we see lots of potential, not only in climate tech as a whole, but specifically in everything related with water and oceans. So that's an area that we've been doing a lot of work with.
And in terms of being patient, do you think, Sergio, that investing early is important, following company through their whole cycle?
Yeah, I mean, patience comes with the territory. If you're not patient, you don't do early stage. Now, I think patience is fundamental, and what Ben was saying, right? Climate tech, everything is going to be climate tech in 5 to 10 years. You can't have a brand if you're not careful with water, if you don't measure carbon footprint, if you're not efficient with your staff, right? So everything's going to be climate tech, and we have to kind of go back to this idea of public to private partnerships. We wouldn't have SpaceX if we didn't have NASA or ESA in Europe, right? So it's really important that private capital, but also public entities get together, because talent is coming from public entities in Europe largely, right? And we need to be able to drive these forces, and we need to be really, really patient, because we don't really have a chance. We either change the world or we're gonna have a serious problem. This city is gonna be 5 degrees warmer in a few years if no one does anything about it, right? So that is really important, and the way you go about it, it's just by investing, being patient, and trusting the best people that are there right now building things.
Yeah, so founders in the room, if you have a climate idea, you know who to go to. So thank you very much for joining us. Please give them a big round of applause.